Ladies and gentlemen, good day and welcome to the HDFC Bank conference call hosted by Spark Capital Advisors India Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ganesh Ram from Spark Capital Advisors. Thank you, and over to you, sir.
Thank you, Rayo. Welcome all for this conference call with the management of HDFC Bank. We have with us Mr. Srinivasan, CFO of the bank, along with Mr. Ajit Shetty and Josephine from the Investor Relations team. The management will take our questions on the structural long-term prospects of the bank. Srini, over to you for your initial remarks on the bank's priorities and the strategies, and then we'll have a question. We'll have a conversation on various questions which I have in mind. Over to you, Srini.
Okay. Yeah. No. Thank you, Ganesh. We appreciate the opportunity to interact with you and with the investors team called in today. Thank you for that. In terms of introduction, maybe we can take it in two steps. I'll be brief and then get on to the deeper aspect of it in the Q&A, or if you tell me to continue, I will continue. But I'll give a very brief overview on two aspects. One is the environment, the macro, and the second one is on the strategy. Right? We won't go into individual details, but we'll just mention high level. The backdrop in the macroeconomic coming out of the COVID, while we are not fully out of it, but more or less we see significant improvements coming out of it. The activity pickup, the indicators that we see that got released in December or January, even for that matter, shows a significant momentum being gained, right, in the process of recovery. The PMI continues to chug along. January better than December in terms of PMI. In terms of the GST collections, again, one of the indicators that shows very record high, 1.2 trillion in January Indian rupee compared to 1.15 trillion in December. So that what was in October, November, December, good amount of festive influence. It is built on that and continues to move along, right? And the auto, which also was very good during that prior quarter, continues to do well in double digits, right, in January. The rural demand seems to be better, again double digits, right? Like if you look at the tractor sales in good double digits. So these are all some indicators that show that the economy is resilient coming out of COVID and moving, right? And where does if that is what is happening? If you ask where is the economy from a output point of view or a GDP point of view, it is our house view that will be marginally positive in Q3, 0.8% or so, and will recover further in Q4, which is January to March quarter, 1.5% or so. So much so that full year estimate in-house view that we have is a negative 7.3, right, coming on the back of -24 and -7.5 in Q1 and Q2. So ends up at a -7.3 or so, right? And then that augurs well because of the base effect implies that the FY22 should be quite good. Our house view there is about 11.5% or so is the GDP growth we expect, right? And we are not very far from what the government estimates are in the fiscal budget time. Whatever the government had given an indication, not far, here and there some decimals, but still slightly stronger than what was previously published in the government kind of a speech, right? So we expect that the pre-pandemic output levels by end of 21 calendar year 21, we should be at or above that level. Very few countries in the world, right? Perhaps US and us. China, these are very few countries who are going to be at that kind of a level, pre-pandemic level, by the time we end 2021. Otherwise, most of them are expected in 22, but at least from our point of view. But then if these things are all good, what is the kind of macro watch out, right? Watch out on the macro front, what it can be. Inflation, of course, as you would expect across the globe. That is one thing that is widely getting watched, and for us also it's the same thing. But fortunately, the recent kind of disclosure on inflation is quite all right, right? It is at 4.06 in January compared to 4.6 recorded in December. So it went in the direction of going down, a 16-month low from that sense. But our house view is that this is more of a base effect, is more of an aberration. We do expect that by the time it is February, March, it will go back to kind of a 4.5 or thereabouts, right? It will go up. But the sticky part is the core inflation, core CPI inflation, excluding food, fuel, etc. That is sticky at 5.5. Even in the recent disclosed number, it is still sticky at 5.5. So what does that mean? If the core inflation is sticky, the headline inflation came down, but we expect it to be back up in February, March. Where does this take us to, right? We think perhaps we will have, while this quarter, January to March quarter, could be around 4.5 or so. We expect between 5 to 5.5 or so in the first half of FY22. And then in the second half, ease a little bit into 4.5, 5 type of range, which is not bad, but that is at least, it is going to increase before coming back down. So from that sense, inflation is indeed very widely watched, very important kind of a number that things are happening, because that drives the macro policy in terms of the rate outlook. Our again house view is that the RBI will keep the rate steady in FY22. That's our view, that the rates will be held steady to support the growth, and which is what we have seen. And if the rates are steady, what happens to the liquidity in the market, right? Liquidity was 6-7 trillion prior to November, December. And then over a period of, I would say, December, January, it came to 4-5 trillion. So there was a mop-up of liquidity, taking out something because the inflation was creeping up, so liquidity was being sucked up. But then the rate curve had to be managed through open market operations, more of a twist operation, buying on one end of the curve, selling on the other end of the curve to keep the yield curve benign. Didn't succeed well because the government did come and say that they're going to borrow. So the market ran up the benchmark 10-year curve. 10-year rate went to almost 6.2, I think, yesterday. So, and the Reserve Bank has been talking it down to say they would like the spread between the overnight to a 10-year at about 150 basis points, which means it has to be about 5.5, give and take maximum 6, but it's crossed 6, right? So it continues to be a lot of debate and discussions about how the central bank will work its way towards bringing it back down below 6. It's a work in progress that both rhetorically as well as through market operations, certain things are happening from that sense. Then if that's what the kind of a rate scenario, where does this lead to credit demand in the market, right, in the macro? Credit demand has been steady all through this period. It is around give and take 6. The January number came at 5.9. The deposit, again, double-digit, 11% growth in deposits. That, again, is quite reasonable, at least at a macro level from that sense. People sitting on money and savings, 11%. Credit demand at 5.9. One would expect it to go up, but at least it has been steady around that 6 kind of a percent, right? And then with all of this, if you think what is happening to the fiscal policy, which got recently announced, quite favorable, supporting the infrastructure kind of increase in spend, 35% increase year on year, pick up in the infrastructure spending, which is fantastic from that sense. The DFI, Development Finance Institution, being set up with a capital being allocated for that, and call it, for lack of anything else, a bad bank or something, right? For another good name we should find for it, to set up an institution to take over some of the troubled assets or stressed assets from maybe public sector banks and put in there for a centralized management. Some of these augurs well, right? Apart from spending on the infrastructure, which is a fantastic, and then focus towards a rural kind of a spending that plays to our strategy. So these are some of a very high level, I would say. Now, how does this fit into our bank strategy? We have talked previously about the 5 pillars of our strategy. They remain. They continue to be there. It was It was started more than 3-4 years ago. It gained a good amount of momentum pre-COVID. During the COVID time period, we continued with those strategies. And now post Mr. Puri retirement and Shashi at the helm, we continue to emphasize and we continue to drive those strategies and it is doing well and firing on all cylinders on that front, on the strategy front. We can dwell deep into it as we go along on any of the topics as we go. Ganesha?
Sure. Thanks, Srini, for that. Let's dive a little on the topic that you just started broaching, which is the management change. So let's contrast and maybe give your thoughts on how you are seeing the strategic trust of Shashi vis-a-vis Puri. How do you see the priorities evolve under the two CEOs?
Okay. See, one is a strategy that remains the same, right? And priorities are more topical, tactical, time period driven because you want to do a few things at any point in time. That's how you think about priorities as, right? Priorities, if anything, helps to drive the strategy. Then they're not standalone. Priorities don't mean anything. Priorities are topic of the day that is driving the strategy forward, accelerates the strategy or makes it wholesome to ensure that, right, at every point in time you'll have some priority this quarter, next quarter, or this year, next year, kind of thing. So from that sense, what are those 3 or 4 priorities that we are focusing on? One is certainly a technology priority, which is to say technology means the digital 2.0. There are several elements of the technology strategy. One is, of course, I wanted to say that the issues that we have had in terms of the outage is more process related. At any point in time, you or anybody want to go into detail, we'll go into that. That is more a process than a technology. We can describe further. We have described in the past. We'll describe again where necessary to explain that further. So that is in terms of setting up, continuing to recruit people with a fintech type of a mindset, setting up a digital factory, driving certain initiatives in terms of helping the business grow in a digitized form. We can go as much as you want. That is one of the priorities. Another of the priority is that from an RBI mindset point of view, from our people mindset point of view, where we were an organization where everybody would look up to a centralized compliance team to see what we are complying with and how should we comply with and so on. So now we are taking it to the people. We are taking it to the business verticals, channel verticals to say they start to interact with the compliance directly with the central bank so that we broad base that kind of a culture and that kind of a discussion. So it is not in a centralized manner, but how do we have broad-based conversation and prioritize that so that everybody knows what it means to be in compliance, right? So that's the kind of a thrust that we are trying to give into. Third one is the priority is the customer experience. Again, from a tactical point of view, we did introduce the Net Promoter Score some time ago. We have a long way to go to perfect it, to make it much better and to make it hum and sing. And customer experience, again, driven partly through technology, partly through mindset in terms of how we approach a customer and resolve, let it be customer complaint or customer query or the way we service things, and to bring down, essentially to bring down any kind of a complaint, any kind of an issue, how do we manage it, right, in a structured manner, and thereby Net Promoter Score is becoming an important element of our day-to-day life, and how do we drive that, right, a bottoms-up Net Promoter Score. I would say that these are kind of, and then lastly, of course, in terms of the people and people culture, what I mean by people and people culture is that how about 120,000 people, 120,000 people, 10,000 of them call it managerial, the rest are all various people in hierarchy working. And now with a new emphasis in terms of training, in terms of coaching, in terms of supervisory leadership development and all of that. So we are making a lot of emphasis in this and people undergoing some training, reinvigorating the process of how people manage down the chain And this is again born out of how we network and keep close relationship with people in the hierarchy along. And one other thing that was driving this is also some recent events of last year, where we have seen a few handful of employees were operating outside of the code of conduct, which was not something that we liked, right? We discovered, because through a process, outside whistleblower process, we discovered there are a bunch of handful of employees who are not in line with code of conduct. So how do we should be knowing it. Our system should be bubbling it up, and we should know. So as part of the training, culture, coaching, supervision, leadership, we are trying to imbibe that within the every vertical chain and leadership, to say how we should be hand in hand with the people, taking them along, and if something is amiss, how the leadership along the way bubbles up to exactly surface this, rather than somebody else telling us what's going on at the bottom of the chain, right? So those kind of people related, we are handling. These are the kind of top priorities, I would say, 4 of them at least.
Sure. Talking a little more specifically, if you look at your this year's the kind of growth, loan growth that we are seeing in your bank, for the first time in almost I don't even recall when the last time, must be 15 years, that we are seeing your wholesale loans outgrow retail loans by a magnitude of almost 5 times, right? Almost domestic, your wholesale loans have grown 25%, retail loans have grown 5%, whereas the system, everybody else is seeing opposite. It is seeing a contraction as in wholesale growth. So what is HDFC Bank seeing which others are not seeing? Are you ahead of the curve, or do you, or what indicates this, if I can call, higher risk appetite?
Okay. So first, it is not higher risk appetite, and I will explain that in the end, right? Because since that was the last sentence you had, I want to clarify. It is not higher risk appetite. And as I complete it, you will see that I will give examples with some numbers on that. See, if you go back at least 2 years or so, which is, think about 6 to 8 quarters or so, if you see, there was an acceleration in wholesale. Generally, wholesale was in the 20s growing. Go to 6, 8 quarters and see it was. And retail was in the 20s. High teens to 20s, that's what retail was, and wholesale was actually in the 20s. And our mix of wholesale versus retail, our book, historically, in the recent history, the retail was 52, 53, and wholesale was 47, 48%. That is the kind of, and that very much, if you see, was how the GDP of the country more or less kind of operates like that, right? So that means we have a fairly balanced participation in the economy from that sense. And then came COVID. We were growing in that we were quite, both of them were equally growing, except the percentages in the wholesale was looking high, because the wholesale absolute amount was lower, so the percentages was looking a little bigger in the past. Now came COVID, and even before COVID, as the macro was coming from 7% to 4% GDP growth, there was some level of tightening and cautioning that was happening in retail, or we were seeing more rejects more than anything from our policy point of view on the retail front. And so it was getting to be in the teens around that time. And wholesale was still all right. And as the COVID struck, as part of our engagement and what we have done over the past 2 years with various top-notch clients, one is system integration through APIs or through host-to-host integration on lending, on FX, on trade, on cash management, which is collections and payments. So wholesome relationship that we have formed with all of them. And the corporates were looking for, like globally it happened too, not just in India. The corporates were looking to load up on liquidity as the COVID was unfurling around that time, which is, call it February, March, April kind of time. All the corporates were thirsty to load up on liquidity and set. Globally it happened, for us also, here also it happened. And for us it happened more than, for us means for our bank it happened more than anything, because we were very selective. We had the liquidity, we had the capital, we had the relationship with each one of the top corporates, and our engagement with those corporates told them that we are here to do business with them. It is not we'll do business today, no business tomorrow. We will be with them. right? And so they preferred that. That's what you quoted. The system wholesale didn't grow. How did you grow? Yeah, they preferred us more than anything. We have open lines with various corporates. They preferred us. And then from a quality, if you look at it, which is what we have talked continuously more than 4 or 5 quarters, every quarter Jimmy Tata mentions that, our wholesale book, we rate the book 1 to 10, 1 being the best. And our internal rating is about 4.34, 4.3 and change, call it, right? That is the internal rating, which is equivalent to a AA, which is quite good. And the incremental book, all through this, if you tracked us over the last 4 quarters, you will see the incremental book is also there, which is top-notch corporates, public sector undertakings, right, which has got great deal of a government backing. So these are the kind of organizations with whom we have worked, which is what you will see even in the RWA, right? Our RWA efficiency came from 69.70 to 65, right? That is because the retail came down as we tightened the policy, and there was one is tightening, and two, even April to June quarter, there was hardly anybody borrowing anything. There was no need for anybody from a credit card to personal loan to anything. The things were shut down. Nothing was there. And then as things started to slowly pick up after that, people were finding to stand up on their own feet, so it was still slow. Then about August, September, I would say that maybe by September, we had seen good amount of retail pickup happening around that time. And through the festive October, November, December, it came back quite significantly up on the retail front. So that is why more than year on year, when you say year on year, retail was like this, wholesale was like this, year on year is somewhat a misnomer. One has to look at sequentially how things are growing, right? How things are happening sequentially. Even in our own book, if you look at sequentially, the retail speed was more than the wholesale speed sequentially in that quarter that went by. And that is how we are seeing now too, in terms of how sequentially. Year on year is a misnomer because in April to June quarter when you had nothing, and similarly July to September quarter was very benign, you would see that the year on year is somewhat distorted from that sense. So you have to look at it. And then lastly, I do want to leave this, another point is, while the wholesale could be could be a 1% or whatever kind of a percent that you quoted, very benign, but that is at a macro level. You do need to look at that impact. Which are those good corporates? The top corporates in the country did not cut pay, did not stop production, did not retrench anybody. They kept and did what they want to do. That is where we are doing the business with that kind of a group, and that is what I was quoting the rating profile of the customers' total book as well as the incremental book. So when we are doing business with those top-notch corporates, we didn't see much. So when the macro says very low single digit or absolutely wholesale is not growing on credit, one has to look at it by industry, and one has to look at it by even within the corporate by various segments of corporate, where it is growing and where it is not growing. But certainly the top-notch clients with whom we do business, which you are seeing too in the wholesale profits. If you see the margins on the wholesale businesses as they report, the corporates report their results, you are seeing that their margins are much better. They have managed through cost very well, and they have reported very good returns. The top-notch corporates I'm talking about, they have done very well, which is what we are seeing and reflecting in the business that we are having on that front.
Understood. From how the unsecured book, in terms of strategically, where do you see that, say, over a period of, say, next 2-3 years? It's currently at about 17-18%. Where do you see that settling over a period of time in terms of your priorities?
Unsecured book, I guess you meant the PL book and the
unsecured,
cards.
Yeah, credit cards and
PL.
personal loans primarily.
Personal loan and credit cards predominantly. Correct. From that sense.
Correct.
Unsecured, I guess. Yes, on the retail front. No, it is a top priority for us, and we would love to grow that robustly. The credit penetration in the country is pretty low from that sense, right? Very low. And we would expect that to grow very robustly as we go along, and we'll participate in it. Our market share is still low. At an aggregate level, market share is low. Our loan market share is only 8 or 9%. Our deposit market share is 9%. So from the way we want to grow point of view, we have a long way to go in terms of the growth. But the focus on the unsecured cards and PL, we continue to have one of the robust databases from a data warehouse point of view, analytics point of view, credit scoring point of view, with our P27 model, which has got more than 50 variables in it. We have our own scoring in addition to the bureau scoring. So we have some sophistication with us, and there are some predictive analytics in terms of collection capability and so on and so forth. So we are using all sorts of things that we can, and we deploy all of them. First we test them and then we scale them, and we continue to be chugging along on that. That doesn't mean the secured products, call it the auto product or the gold loan product or the home loan product, we are not focused. That is also a great deal of a focus. And I would say that we'll have a balanced growth between secured and unsecured as we move along. And the market, the credit penetration in the market is pretty low. So there's only one way, apart from getting some shares from other banks, mostly say, call it public sector banks. The market expansion is also something that is happening where we are playing, and we are actually driving some of it, and we are playing wholesomely on those.
So you are not, so basically you're telling you're not seeing any kind of untoward signals coming in the unsecured loans in terms of consumer behavior patterns, which is making you want to go slow or you want to cap it at a certain level. That's not the approach out here.
No, that's not what we are seeing, or that's not what we have worked on. Our policies consistently are the same. We have certainly through the COVID period seen number of rejects, and even pre-COVID we have seen the rejects increase. Pre-COVID, when the GDP was falling from 7 to 4.5, we have seen more rejects than what we have seen in the year before that. Yes, our models and how they are calibrated and decision making remains consistent. And we were quite confident of moving along with that.
Understood. From how do you see the consumer behavioral patterns changing post COVID or beyond COVID? What kind of disruptions do it is in the top of the mind recall for you? Are you working with any such potential disruptions eventually coming your way?
We can call it disruption, or we can call it different models of how you operate, right? Whichever way we think about it. Certainly one of the, I think, is broadly defined digitization, digital approach to things is a gamut change. That is there for good. Many things have happened even for us during the last 12 months and will happen as we go along, which is from opening a straight through liability relationship. Previously also we had a digitized account opening, but we had some hops, manual hops and props. But in a very quick time, we stitched as the COVID came along, and we made it a real straight through. Then the Reserve Bank helped the industry in the form of video KYC, because as part of the AML KYC process, you need to verify the customer. So the video KYC was introduced, was approved. We embraced it, and that made it even more digital in terms of elegancy, in terms of moving. And so much so, last quarter we booked 2 million liability relationships. And the March 20 year, we booked 6.5 million for the full year. And the year before that was 3.5 million. So the last quarter, if you see, is at a 2 million, it's like a 8 million type of run rate, right? That's what is going on. So certainly, broadly, we are seeing the digital approach. And then that is one. Two, from a cash point of view, the government is, there's a huge tailwind coming from the government trust point of view to remove cash transactions and make it a digital transaction. And that's part of our merchant strategy. One of the strategy we have is the payment strategy, where about little more than 55 million is our estimate of merchants in the country, with only 10% penetration, digital penetration. The rest are cash. And we have 2 million of such merchants already signed with us. And we believe that we have a long kind of a runway to go, where we have a stated objective. We want to take the 2 to 5 to 10 to 20 over a period of next few years. And we are going through that. That is a structural change that's happening in the economy, and we are very much front and center participating in that process of digitizing those kind of payments and the customer relationships from that sense, right? And it is not only payment that is relevant to us, because payment of fintech will come and do the payment, right? Because payment as such does not make money. There is no profits in payments. But Along with the payments, when you have the liability relationship and the asset relationship, that's when you bring in the holistic customer relationship into play. Then it makes sense to be in that business to do, which is how we are addressing. We are not addressing payment as a payment. We are addressing payment as a holistic relationship of a liability, asset, and the payment all together going with it. And not just only for that merchants, but for the merchant family, their individual accounts, their family accounts, and their business accounts all entangled together as a wholesome relationship. That's how we are addressing that. So that I would say from that sense. From a wholesale side, at least the way it is moving on the wholesale side is currently we do see that the loan demand can go down a bit, even from where it was in the last 12 months can go down. Until the private sector starts to make capital investments of a big order, it is only working capital requirements. And that working capital requirements, the cycle has come down because the cash and carry through the COVID was pretty of high order, as you would have seen. And so the working capital cycle crunching will make the credit demand there pretty lower than what it was in the past. So the wholesale can come down as we go along. Come down, I don't see contraction, but the demand from an overall sense need not be the same level of demand where it was previously, because the working capital cycle is going down. Of course, if the private sector starts to participate in what the government is doing on capital expenditure side, where there is a 35% increase in the capital expenditure outlay in the budget, if the private sector joins hand and starts to spend, then you start to see good humming coming through the wholesale side also on the loan side. This is where I would say things are changing, and this is how it is changing.
Sure. The Reserve Bank of India put out this circular on the whole current account structural changes which are there. We have been seeing a sequential growth in your current accounts of late increasing, but it's coming into effect from next month. Do you see that circular being a material benefit for you and for larger banks? Do you see current account deposits scaling up? What is your broader thoughts on that?
No, I will not say that we have benefited or even at that stage lost, because by the time we were into December quarter, not many implementation of that circular had happened, right? The people were still discussing through the IBA in terms of the logistics of how this will operate and trying to understand. Time will say what is going to happen is that the lending relationship that is where the current account will consolidate over a period of time, right? And we do have a good amount of lending relationship, and thereby some current accounts might come to us. Whether on a net basis it is going to be a hugely positive or hugely negative, I don't think so. But whether it can be slightly up or down, it can be slightly up or down. We don't know. As we implement and fully get to see the end of implementing that circular, then we'll know where it goes. But then our objective is, if the credit quality is good, we want to be extending the credit quality and keeping the float, right? Let the current account be with us, the cash management operations be with us. Where it is a marginal lending player, we'll let it go and go to another bank where they can do it. Some other bank has got the appetite, they can take it and move on. So I would not say that it is going to swing in a big way left or right. Yeah, marginally up or down is possible. But what you have seen in the recent past has got nothing to do with that particular circular. It is because by that time it had not been implemented fully or not even partially. At that time, people were still talking the logistics of implementation. It is simply the sense of the liquidity in the system that people were parking at any point in time.
Sure. Rayo, we can actually start setting up the question queue. I have one more question, but we can start asking participants if they have any questions. But I still have one more question to ask while the queue is being formed.
Sure. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles.
Can I continue, Rayo, in the meanwhile?
Yes, please go ahead.
All right, sure. Srini, what's your view on this whole Reserve Bank of India's working group recommendations restricting banks from owning more than 20% in any other financial services in a associate or a subsidiary? Assuming these assumptions go through, what's your strategy on HDB? Do you plan to have a no HFC structure, or you reduce the stake to less than 20? Also, what is the plan you think will eventually play out for the parent also in its stake out here? Just, it will be good to hear your thoughts on the overall structure.
Okay. See, one is that it is still paper, and the feedback that was called for from various quarters were provided by many. Each one, all the constituents had different views, right? So all the views have been channeled in. And but then it has to undergo some other process within the regulator organization to see how to land onto a policy on that, which could be some time away. I don't have a particular time frame or knowledge of when that will be. So that is one thing. But your point is, given what it is, what would you do? See, we have all options on the table from that sense. We can do all of that. And one of the options we said is that we can dilute our ownership in the subsidiary. That is certainly one of the choices we could do. The subsidiary could be simply originating machine, which is also so that there is a cap on the asset. It doesn't need to grow. There's a limit up to which the subsidiary can have the asset, up to which need be no change. They can just continue to the extent that the assets are below a certain level. They could be an originating machine, originate and pass it on, and the bank has got good appetite, good liquidity to take the assets to the extent that it is of the target segment that we want. To the extent that it's not the target segment, there is enough market appetite to buy from them, right? So that can be another strategy. So there are several of these that can play out. So it's not one or two. We can play out 3 or 4 such strategies as we go along, and we'll be open to any of them, whatever brings in good value for shareholders, for sure. Right? So that's something to have in mind. Then in terms of the parent and so on, yes, that is I think based on what you're saying is the non-operating holding company or something like that, right? That also there are several strategies that can be established on a non-operating holding company, where with the way we are in, we can still operate in a non-operating holding company structure without much fundamental change to our approach. And that is pretty possible, right? We don't need to do any more changes than where we are, except that the bank can operate as a subsidiary with a non-operating holding company on top. So there is no fundamental change that will be required or necessary. Whether there will be, once we know the paper and whatever is the optimal at that stage, we can decide. But we should be able to operate the way it is, even if it is to come in that form.
Got it. Any questions? Okay. Let me just, in the meanwhile, let me just keep continuing while the question queue is being formed. What is your view now, given that on the merger or the cost of merging HDFC Bank and HDFC, given that the effective cost is kind of now lot lesser than it used to be, because just the sheer scale has diametrically changed. You are now almost 2.5 times the size of HDFC, standalone loan book. So the historical questions of the cost of merger is no longer as relevant today as it used to be in the past. So in that context, is your stand of merger between between HDFC and HDFC, does it still hold, or is it undergoing a change?
See, in the past that you mentioned, the costs were outweighing. That was the kind of a rationale. There's more cost to a merger than the merger benefits itself, right?
Exactly.
To me, fundamentally, that situation has not changed. However, once we know what the final rules are, then we will know. But anything that happens, there has to be an economic value creation at the end of the day. If there is no economic value creation, then the combination is just for the sake of combination, for the sake of size. That's not what we are looking for. We are looking for, if there is anything, what is the economic value? The previous working said there was no economic value creation. If anything, there was a detriment because the costs were outweighing the benefits. And as we see now, that is what I also see in terms of the cost outweighing benefit. But once we know the final pluses and minuses, if there are any rules or any kind of changes that come, then we will know more. But at this time, one, there is no such conversation. Two, there is no such benefits that I have seen. The previous, I think, whatever you alluded to remains exactly similar.
Understood. Are you seeing any signs which is giving you data based on how your corporate customers or any other customers are telling you that capex cycle is likely to start, or government infra spend led is going to drive likely demand of a character of loan book which is not seen for the last 10 years or so? And if it comes, will HDFC Bank want to play a role in gaining project finance loan opportunities also, or do you believe that project finance is not high up in the pecking order in terms of ALM issues and you don't want to take it beyond a certain proportion of your loan book? What is your view on that?
No, sir. From what we hear, the government programs on infrastructure spending, thereby the capital drive, is quite positive and very good. Right? The private sector has not jumped into it, and that is why the public sector, that is why the government is leading the effort. We haven't seen in a big way. There are some pockets of private sector trying to join hands, but we haven't seen in a big way the private sector jumping in at this stage. Right? Time will tell if they are jumping or not. And what happens if they do? And where are we in our situation on that? Right? Yes. We are not shy of participating, but within our risk appetite, within our ALM limits, that's where we can, for the right projects, where we see good potential cash flows with good corporate type of backing. Right? We won't be there generically across the board. We are not there, and we are not there for any project. We want to see the project which has got a good potential for cash flows backed by a great corporate. We'll be there to the extent of our risk appetite that we can, not wholesomely, fully participating, but wherever we could, we will. ALM, as you said, is a very important criterion, right? You've got to manage the cash flows with all. If there is a long gestation for eternity, we cannot be waiting. So we need to see, and we need to see what that corporate partner, the big corporate, high-rated corporate partner, what will they bring to the table to reduce that gestation or to manage those cash flows.
Got it. Talking about competition, okay, over the last 10 years, we have seen the state-owned banks with their capital challenges and other constraints cede a lot of market share to well-capitalized private banks. Do you see that runway for that sustaining over the next 3, 4, 5 years also, or do you think now there is mergers happening, there is capitalization which has happened, and the nature of growth, which is going to be more corporate and maybe little more muted retail, will that lead to competition from state-owned banks likely to intensify over the medium term? What is your read on that?
Okay. One is competition from the public sector, whether it will increase. It might increase a little, but I don't see it significantly increasing. The second thing is in terms of the public sector banks did not have capital and to lend, and thereby coming to the private sector is partly true, but not entirely true, because the kind of customers, corporate clients who came to the private sector is not just because the public sector were not lending. There were certain public sector banks which were lending anyway and had great amount of liquidity and capital. But it was more in terms of the relationship, in terms of the digital approach, in terms of API networking or the host-to-host integration, providing the cash management. That means the technological solutions. Right? I'll give you an example which if our corporate banking head was in this call, this is how he would have described, because he was with me in one other call a few months ago, and this is how he described. Right? When he visited a client in Uttar Pradesh, he went to visited a client, went to the client's office. He met the treasurer. And then he talked to her in terms of opening the business and doing deeper relationship with the client. And her comment was that so appreciative of that she formed a relationship with our bank, and that she does not need to leave her office. The public sector bank was in the same street as their bank, and where she had to visit physically to get things done. And whereas for us, it is everything sitting in their office, they're able to do things, including send the documents. When they want to do an FX trade, it is host to host is doing the FX trade at a predetermined spread to the interbank. So there's nothing that is required for them to call and book a deal and agree on a rate and so on and so forth. Trade documents. Electronically, trade documents are transmitted and trade finance happens, right? So these are all the approaches. She is recapping to and saying that any day I will do business. Thanks for bringing it to us, opening our eyes, and that's how we want to do business with you. And it is making our life much more easier, and I am able to focus on my day-to-day work and not worry about my banking service because that's getting taken care by you guys. So that's the kind of comments and that's the kind of inputs that several of the clients tell us. So it is not just about lack of capital, it is also about the product, the breadth of product from FX to trade to collections to payments to lending term or working capital, and most of these in an automated manner. That is what they are looking for as a differentiation. And whether us versus another private bank, is there a big deal of a difference with it? There may be some small differences here and there, right? And most of them are similar. We'll have some edge on certain things in terms of products or turnaround and so on and so forth. But certainly we have a greater relationship management approach. We certainly have that. And we have demonstrated through higher capital and liquidity to be available to top-notch clients funding their needs. So that's how I would characterize that as in terms of public sector bank versus us in terms of how we approach. And competition going forward will, if they change and bring all of this, there will be competition, but it is some time away, I guess, from rather than even a medium term. Consolidation of public sector banks wouldn't make this as smooth as what we are envisaging.
Sure. Is there any question in the queue, Rayo?
Yes. Before we take the next question, a reminder to participants that you may press star and 1 to join the question queue. We have the next question from the line of Scott Thomas from Wasatch Global. Please go ahead.
Yeah, hi. Thanks for doing the call. I just had a question on your digital strategy. If you could elaborate a little bit more. You know, there's all sorts of fintech disruptors moving into the payments and banking space. What is it that you think you have to get right from, call it a competitive standpoint, and facing those competitors? And then particularly from a payment mechanism standpoint, I know you have a large credit card book. I'm just curious your take from, call it the payments mechanisms and, you know, credit cards, UPI, and how that evolves.
Excellent. Thank you. Thank you for leading into that. I touched upon it only for 30 seconds or 20 seconds along the way on this payment, but you touched upon it, so we'll go a little more deeper into that. See, payment strategy is one of our 5 pillars of strategy that came up more than 3-4 years ago, and we are full notch going into that, right? Again, the context of the market, 55 million merchants, only 5 million are digitized, and we have 2 million so far digitized by us. That means our merchants, right? And we have a long way to go, expansion of the market and getting more share, right? And from a payment point of view in this country, if it is depending on online merchants or a physical merchants, our share is anywhere, however we measure, from 40 to 48, 49%. That is our market share in this space. Yes, you are hearing about fintech players entering that arena and competition heating up. We see it slightly differently, and I'll describe that. The payment strategy, the payment as such, right? That means doing a UPI payment or doing a debit card payment or a credit card payment, right? That means that is simply processing a payment in a merchant swipe the card or through various payment factors, through the net or through various the smart pay approach onto their screen, right? QR code and so on and so forth. Several ways in which you can pay. The payment as such on a standalone does not make any profits. So that means for us, we break even in a lucky month, we break even. Sometimes we are couple of basis points negative, sometimes we are couple of basis points positive. So at best you can say payment as such is a losing value proposition. It is not a money spinner. So then why are people in payment? Fintech, I don't know. You have to look at their model. But I can tell you about our model. Then why are we in payment? If Srini, you tell me payment is break even at best, why are you in payment? Because we are in payment because we are a bank. And in a bank, the first relationship that we form in a payment relationship is opening up a liability account, a current account where we get a float. Because we are a bank, we can open a current account, we have a float. So that means when the payment is swiped, the money comes into that current account, and that is where, and the merchant is able to deposit the money in the current account. When they have cash transactions or other transactions, it is there in that account. So we get a liability relationship. Second liability relationship. If it is a small enough merchant, we have the merchant's own account and family accounts also as part of the relationship. And I'll describe why and how later as we go along. So we have that relationship. If the merchant is a big enough merchant, that means it's a Reliance Digital or a Tata Chroma or some other big stores, chain stores, or a big corporate type of a retail store, right? The relationship is apart from payment, it's a relationship of their salary accounts, their employees' salary accounts, and in addition to their liability management account, right? Collections and payments accounts, in addition to that. So that is how the relationship forms. Because we are a bank, we get that liquidity first into it. And then as we get the liquidity and as we see the visibility of the cash flows, we have a lending value proposition. If it is simply the last one I described, the employee salary accounts, we make lending available, personal loan, credit card, etc., based on the credits we see in the account, based on the cash flows we see in the account. And same with merchants. We give a lending relationship to the merchant based on the cash flows that we see. So now we got a liability relationship, we got a lending relationship, payment is there, incidental, it operates. And now on a marginal basis, you see that payment starts to make money because now you got a wholesome relationship coming, then that is how you start to make money on that. Now, anybody can come and do it, any bank can do it. So what is your unique value proposition for you, for that merchant to stick with you? As much as we have signed that merchant, 3 more banks can go and sign the same merchant and say, I'll give you this kind of facility, a benefit or whatever, come to me. What is our value in it? So that is why we are now trying to do some value add services into those merchants. What are some of those examples of value add services? One, what locally we call the kata, but you can imagine as the books of accounts, right? If that merchant is operating all the transactions electronically through the payment system into our liability account is nothing but a mirror of that merchant's books of accounts. Exactly the mirror of the books of accounts. And it helps that merchant in the form of GST, which is the local sales tax or other taxes process. Everything is streamlined and straightforward because our ledger, our account is the mirror of their ledger, right? So it makes it, so we, through an app approach, through a third-party app approach, we don't give that app. Through a third-party app tie-up partnership, we try to give that aspect to them. Then, in addition to that, we are also giving an app for inventory management, so that that merchant is able to look at the inventory, which in Western countries you see that in the US, many of them have inventory in their payment system where they swipe the card, they can see what is the stock code and whether how many numbers of that item is already in the stock, when they should reorder, etc., etc. So we provide that through an app approach as a value-added approach. Third, which is the most important of all, is the hyper-local offers. See, we have 60 million retail customers, right? So pure fintech will not have retail banking customers of that order, but we have 60 million retail banking customers. And through the PIN code or equivalent of the zip code, wherever that merchant is located, we know who are the 60 million customers in the vicinity of that merchant. And we tied up, during this festival period, we tied up with several thousands of such local merchants to make a local, hyper-local offer. So which means in the vicinity of that particular merchant, we're driving the footfall of our customers into this merchant. And the merchant is able to advertise and bring them in through WhatsApp advertising or SMS messaging or through email messaging and so on is able to bring the customers in to offer, to give better price or better products for that matter, unique products. They are able to draw the customers in. This is something our merchants love because we are trying to network with our customers in that local area of that merchant and bring the footfall into the merchant, and which is the unique value that we are trying to add to the merchant, and which was extremely well received during this October, November, December festival period that we ran, and we are trying to scale that up in a grandeur manner as we go along. So these are some of the things that I would describe why our value proposition is what we are trying to drive the payment rather than a pure fintech approach to driving payment.
Sure. Srini, my last question before we wind up the call on your broader growth outlook on loan growth, and HDFC Bank has, the last all these years, irrespective of macro issues, you have continued your ability to juggle growth, profitability, asset quality, and capital efficiencies better than anybody else in the street. What do you want to prioritize in terms of numbers, in terms of all these variables over the medium term? That will be good to know before we wind up the call.
Okay. See, one thing is that you know us more than anybody. We don't give a particular forecast of anything, and because we don't have even an internal target of this is where we want to take the loans to, right? Because that's not how we operate. We operate through the customer demand and prioritize things in line with the strategy and so on. So that's one thing to keep in mind. But in terms of the loan demand as such, it was true yesterday. When I say yesterday, in the past years, and it is true tomorrow. When I say tomorrow, it is at least in the medium to 3 years, 5 years type of time frame. In this country, the credit penetration is pretty low, very low. I'm not even comparing to the Western countries of America, UK, or Canada, or anywhere like that, right? You have to compare there too, because if everybody wants to be working like the way it happens in the Western world, credit also should go there, but we have to walk before you can run. So I understand that. We don't even comparing to another emerging market, right? Our penetration is pretty low on credit. We have a long runway from that. And so where does that show up? It shows up in demand far outstrips supply. That means there is enough credit demand. All the time there is enough demand. Then how do you pick the demand is the question. That means what is your selection for a credit? That is the question. Do you have products? Do you have the right kind of policies to get the right kind of customers in? Do you have that? And that is where in the past we have focused on these things, and that's how since the demand is so high, we are able to pick what we want. And going forward, we continue to feel the same, which is the demand is pretty high. And with our kind of an expertise that we have developed over years, again, product, process, and analytics approach and policies, we feel that we'll be able to pick the credit that we want going forward, where in the context of where the demand far outstrips supply.
So from the growth margins, NPAs and credit, ROEs outlook, anything which you want to highlight as potential trend difference to the trend going forward over the medium term? Do you think you need to highlight anything?
No, we can take each one and talk, right? There's nothing particular I want to highlight, but since you touched upon a few, from a margin point of view, as a bank, you know that we have operated between 4.5, or more specifically 4.1 to 4.4. Part of our ALCO management approach in terms of how we price products. There's no change in that. We'll continue to be within that narrow band operating. If you look at over the last 3 years, 5 years, 10 years, that's the range at which we operated, and we should continue to operate something like that, right? In terms of the cost to income or the efficiency, we already talked about how we manage through that efficiency process, and from 38, 39. We have said among various things that we don't talk about outlook or a forecast, we said that from a cost to income, we will try to drive towards the mid-30s in the medium to long term, right? So that strategy remains, that kind of a approach remains, right? Again, through digitization, through scale, and that's how we'll try to get to that. And various process improvements, re-engineering that we're trying to do on processes to make it much more straight through. So that's on cost. In terms of the credit cost, we keep the policies pretty constant, and we have tried and tested several of them over the past. And it will be in that narrow band of 10 basis points, 20 basis points up or down in a quarter can happen, but broadly we feel that we should be leading from that sense from a credit point of view. Right? I don't see something different happening. In the short run, COVID, non-COVID, yeah, we have seen some spike too in our numbers. But yes, once the COVID is all done, we should be back to some kind of a normalized type of number. But we need to go through all the COVID process. Then in terms of, you touched upon ROA, yeah, we've operated in a narrow band of ROA like the way we operated on NIM. And I don't see any different approach to any of these strategies or priorities will change dramatically any of these kind of parameters that we're trying to measure and drive.
Sure. I think that brings us to the end of this conversation, Srini. Thanks a lot for your time. Appreciate you taking time to speak to our clients. And thanks to you and thanks to Ajit for all of this.
We really appreciate the engagement and we thank you. And we thank all the participants for the engagement.
Thank you. Have a nice evening.
Thank you. Yeah, you too. Yeah, thank you. Bye-bye.
Thank you very much. On behalf of Spark Capital Advisors, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.